From the morning reading. On your S&P 500 snapshot, the Trump rally appears to be stalled. This morning, the S&P 500 seemed to reiterate its misgivings about Trump's churlish demeanor during its first post-election post-conference. The index opened lower and plunged to its negative 0.93% intraday low about 90 minutes into the trade. A buy-the-dip strategy then steadily lifted the 500 to its fractional negative 0.21% close, a tad below its 0.16 intraday high shortly before the bell. There is no interest in shorting. The number of shares sold short against stocks in hopes of buying them back later at a lower price has collapsed. In funds like the SPY, short interest is the lowest since the summer of 2007, and many individual stocks are likewise showing a lack of short sales. This removes a pool of potential buying interest. A detrended version of the short interest ratio has dropped to a level that has led to negative returns for stocks. The US dollar has been losing momentum. After months of sustained climb, the buck threatened to close below the 50-day average on Thursday for the first time in several months. Over the past 40 years, when it has set a multi-year high, then closed below its 50-day average, the weakness continued over the next several weeks. Nervous ETF traders. Likely due to political rumblings, ETF traders fled the IBB fund, causing it to bleed more than $200 million in assets on Wednesday, its second largest outflow in a year. This is one of those funds, though, where inflows-outflows have not been an accurate contrary indicator. A couple of weeks after other outflows of $200 million or more, IBB had rallied only 11 out of 26 times. There was also a large outflow in gold miners, GDX, the third largest in 3 years, but again, we would caution against using it as a contrary indicator. Breadth strengthened compared to the prior session, as advancers led 1793 to 1198 on the New York Stock Exchange and led 1802 to 965 on the NASDAQ. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:03 a.m. Mountain Time, and I'm recording this in preparation for the market day of January the 13th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and bounce into the morning report. And at the time of this cut, all four of the U.S. broad-based indices were up, but just basically above scratch. Crude oil is down about 0.81%. The euro is up about 0.25%, as is the long bond. Gold is down just below scratch. In overseas action, looks like everybody's open. China's down about 0.25%. Hong Kong's up about 0.5%. Japan's up about 0.75%. Germany's up about 0.2%. And United Kingdom's up about 0.1%. Relatively quiet volume last night, and that's often typical as you come into this Friday. And we got core retail sales, PPI. Also, FOMC member Harker speaking, University of Michigan consumer sentiment. And that looks to be about it. Let's go ahead and take a look at current volatility. It's up a little bit from where it's been super low, but it's still very relatively low at a 9.32 on the short-term VIX. Skew just above the first caution threshold of 125. It's coming in with a reading of 126.22. IV percentiles also extremely low, though perhaps not as low as they've been. The S&P at a 6, the Russell has popped up a bit at a 16, the NASDAQ a 7, and the Dow at an 8. No standard deviation size moves were put in on any of the U.S. broad-based indices yesterday on a close-to-close basis. In terms of the current charts, let's go over there. And you see our action yesterday was a continuation of the consolidation, though with an asterisk. We did have this kind of cut, and it kind of went below the recent price action, but then had a mighty reversal in the mid-morning, and then ended up making up almost all the ground of the early losses by the close. And today's action so far has been nothing significant. So the sideways consolidation pattern continues. And the same thing on the Dow. Again, the big undercut and then the large recovery. NASDAQ, same kind of pattern. A big long tail. And the Russell. Now the Russell was relatively weaker. It had the big weakness, and it did recover, and you see it recovered about half, but certainly nowhere near as much recovery as you saw in the other markets. So we continue to see more weakness in the Russell on a relative comparison to the other three indices. These are all still bullish, though, so let's not get too crazy about that statement. Crude oil, of course, had the big undercut, reversal, and then built on that yesterday, so solidly back in the prior short-term range. Gold continues to build on this retracement, and you know, at some point you have to kind of wonder, is this truly going to be an intermediate term trend reversal? It certainly is trying to mimic one as best it can. Don't have that statement actually established yet, but certainly this is starting to be a pretty significant move that has lasted going on almost a month now. And a similar move, the same thing with the bonds. And, you know, right at a month of this retracement. And of course, this has been related to recent dollar weakness, where it went sideways at first and then actually started to fall. And we still haven't really, I'm trying to see if we, yeah, I guess we'd say that's a lower low. And then another lower low. So, you know, did we have a real break in trend here on the dollar? And that's certainly, you know, related to a potential reversal of trends on the bonds and gold. I find it hard to believe. I think this is just a complex correction on all three of these markets, and that they'll resume their prior trends. But we'll continue to watch and see how this develops. It's interesting that you're getting all this movement, and you can see this in the yen, the Japanese yen, and in other markets as well. You continue to see these kinds of movements while at the same time U.S. equities have been largely flat for a month. And let's take a look at the volatility. Volatility continues to be really, really low, playing around at you know, the 11 handle. So exceptionally low volatility. Okay, let's go ahead and go over to the daily report. Not a lot of change from yesterday, and this is kind of typical of what you get in bull markets. Of course, we're always looking each day, because what's important to us as we measure these you know, elements of risk and so forth, is to see when the changes begin, and then to watch the rate of change, and that we would one day to another individual day not see enormous amount of change. Well, that's typical in a bull market, but we're always sensitive to when these things start to happen. Intermediate term phase opinion, market phase 3, that's a bullish pattern, bull flags and other bullish continuation patterns. The 3 market timing signals, the first one coming from IBD, confirmed uptrend, that's bullish. GMI index, that's also a 5 out of 6 buy signal in place since 11:10, that's bullish. And stock charts, decision point scoreboard, no change from yesterday. We continue to see the mixed signals on the short term and the long term, and this gives us that expectation that incremental moves to the upside will be just that, and incremental moves to the downside will be just that. In fact, for the last month, pretty much the broad market has moved within a range of 1.5% top to bottom. So this is very much reflected in what we're seeing in the decision point scoreboard. In terms of position sizing opinions, both models are at 100%. Intermediate term market posture is exceptionally strong bull with an exceptionally strong bullish sentiment line supporting it. We do have one asterisk to that, and that's the Russell. The Russell has deteriorated into a weak bear. Hedge warning status remains 0+, normal with some elevated conditions. Strategy opinions, you have, first of all, the VIX below a 12, so that is a warning about the initiation of new positions for novice traders. Premiums are very low right now relative to the amount of risk that you're taking on, so for some traders, that would be an unacceptable condition. In terms of specific areas of warning, we've got the various volatility warnings in place that basically say things are super low, so we're expecting an expansion of volatility at some point. And while no signs of that have yet appeared. Trend base, we did have one warning pop up here. Our new lows popped to 311, so kind of keep that in mind. And then on the risk aversion indicators, we still have the 4 as risk off versus only 1 as risk on. Sentiment relatively benign across the various markets, and fear and greed indexes have actually gone into the neutral category. From a sector specific, our action yesterday, you see mostly defensive here. Telecom, real estate, utilities, were all up, but note that, and also note consumer staples basically scratch, but none of these were particularly impressive in their percentages. Even telecom, which basically meant two companies, Verizon and AT&T, they were up by a combined 0.62% as a sector. This is nothing, particularly aggressive going on, but it was mostly about a defensive kind of risk-off kind of move yesterday. As you saw the big intraday move in the recovery, it was being driven by the acquisition of defensive-oriented stocks. Now, who was the losers yesterday? Financials, energy, industrials, all your classic risk on, especially the financials. They had the most, if somebody were to get a little worried about a real breakdown, the financials, of course, have been the big winners in this post-election rally. So people would be relatively quick to protect profits there, I'm sure. In terms of the market postures across the three different time frames, across the various sectors, we continue to see, to a large degree, the same ones listed as relatively weak, though these were somewhat improved yesterday's action, but that was kind of a one-day event. Telecom, consumer staples, energy, retail, and financials have started to weaken a little bit. That's where the weakness is coming from primarily, and you see the other sectors that are holding up a bit better of late. And we continue to talk about, the action of the last month, and you see here the performance of the last day, the last 5 days, the last 1 month. For the most part, very little action that really gain you much. The overall index, top to bottom, has been about 1.5%. You see the S&P in the last rolling 1 month is actually up about 0.5%, and the various sectors are spread out from there, but they're, at healthcare at the best at 3.14%, and at the worst, you're down 1.92% in energy. So if you think about it, healthcare was the one that got clobbered the most coming out of the election period. So this is probably some rebalancing back to the mean, corrective action, kind of bringing some of those extremes back together. Okay, that's probably enough for today. Let's go ahead and roll this thing up. And I'm going to move through these slides here. If you see something of interest, just hit the pause button. Also, you'll see hyperlinks on most of these slides to take you to additional information. If you're a day trader, you gotta have these. These daily price guides are just magic. I love them. Only $25 a month for the full set of daily price guides. The regular whole room membership is only $50 a month, and you get the daily price guides and a whole bunch of other stuff. So take a look at that as well. There are free trials available to kind of get a look. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down at the bottom for the full set of disclosures. We'll see you back here for Tuesday. Monday is trade holiday. I believe some of the futures markets will be open half a day, but the regular markets will be closed for Martin Luther King holiday. So just be aware of that. We'll be back with our next set of reports for the members, as well as this market preview with Tuesday's action. Meantime, manage that risk profile and go out there and seek to learn something each and every day. Good trading to you.